you've got something out of those thoughts there. I'd like to take the opportunity now to introduce Declan. Declan from Valiant Finance tells me he's doing a lot of good business with trade business owners, and I think he's got some good thoughts for you guys today. So, Declan, are you there? Can you come in on our session now?
I'm here. Can everyone hear me?
Yeah, loud and clear.
Beautiful. So, good afternoon, everyone. Thank you for all tuning in, and Glenn, thank you for the opportunity for today. I've assumed today that in the room we've got a bit of a mix, maybe some people who are newer to the industry, some people a few months in, maybe some 5-6 year existing businesses, or even some of you might even be at a stage where you're systemizing specifically so that you can sell the business and wind down your own career. So I'm also aware that a lot of you work in different trades and under different company structures with different sizes and so on. So to that point, I've tried to cover all the bases, and at the end of it, I'll use some specific examples of ways that other trades business owners have actually used cash to capitalize on an opportunity. So borrowed in order to win a job, buy some tools or whatever it is they've done. Now, not all of this is directly going to be linked to managing cash flow, but I think Glenn's raised some excellent points. I've actually added a few things into what I was speaking on based on what he said. The majority of lenders in the market have cottoned on to cash flow being a major pain point of small business owners. And so a lot of the way that the industry is moving is towards creating niche products for specific industries to solve a cash flow need. How do I jump to the next screen, Glenn? Perfect. So this slide here represents what many of you may have been through in the past in an experience in trying to access money for your business. So I won't sit here and bash banks. Banks exist for a reason, but in many cases, often is the case where you may have been to a branch before to visit your local business banker. They might have offered you, or rather told you that there was a chance that they could fund your application. It might have taken a couple of months for them to make that application, and the funds then were denied, and you might have been stuck in a position where you've sort of promised a mate or another tradesman, you know, that you might do a job with him or with their company, and then you've sort of found yourself last minute, money's not in the account, can't buy the tools, so on. So the big difference I want to highlight today is the difference between how things have been typically in the past and how things are changing. So if you've got, it's possible you've had some preconceived notions of actually accessing finance based on a previous experience with a bank or another lender of some sort. If you jump to the next one for me, Glenn. A lot of what Glenn spoke about today is that idea of Pareto's law. I actually used to work for a recruiting company that was pretty much built on Pareto's law. The idea being if you've got top performing salespeople in your company, you can get someone to train under the top 20% of your salespeople as opposed to that bottom 80%, because it's likely that top 20% is bringing in half the revenue anyway. So to the same point, in your own businesses, as Glenn sort of outlined, it's more important that you're either actually on site doing work or actively developing business in order for your own team to carry out work. But typically we found through our own research that 20% of applications are rejected outright, regardless of whether they're going to a bank or a private lender or whoever. And it takes about 30 hours of your time in order to sort of filter through the multitude of lenders that exist in the market, try and find the right one, sift through offers and sort of try and understand how does this one offer compare to the other and so on. So can you jump to the next one, please, Glenn? So one of the main changes in the market is there is a lot more players, specifically a lot more lenders. But not only that, they exist as different types of lender as well. So one of the major things to note is that banks operate in Australia as a bank, and to own and operate a banking license, it means that you must conform to a certain way of lending money, in that you'll need to take a residential security over some form of property or an asset. You'll need to have in the case of a business loan, you'll need to have a business that's been trading for about 2 years so that you can have a good track record of turnover and profitability to show to a lender, but you'll also need to have a good credit history. So naturally, most people fall into the category of, especially those in small business, fall into the category of either not having a residential home to use as security. They might be not as far as 2 years into their business, so their financials don't necessarily look exactly spot on, and they're still growing, still leveling out their turnover. It might look a little bit lumpy, and so forth. But also considering they're starting a new business, a lot of people just have a preference to keep their own residential home out of the mix, so that if all does go wrong, they've got that extra layer of security, knowing that they haven't actually put their house on the line. They should be able to keep hold of the house, and provided they can find a job somewhere, a PAYG job, then they should be able to make those commitments to their mortgage and should be able to keep going. But one of the other bigger differences is that a lot of these guys will specialise. So they've sort of worked out, the banks have really closed the doors to SMEs in general, but in all honesty, trades finance companies can be a bit of a nightmare to fund. The reason is, very specifically, a lot of jobs, a lot of trades as well, they work on progress payment type conditions. So you might have a job that involves you doing the fit out on 10 bathrooms in a residential unit that's being built, a residential set of units, I should say, and you've got to do all 10 bathrooms. And you're working off a contract that basically releases funds according to 100 grand per job over the course of 12 months. I don't have to tell you guys, I'm sure you know this a lot better than I do, but I should say as well, my own brief experience in trades was a couple of summers spent working with a friend of mine who was a builder. So nothing too specialised. I won't in any way pretend to understand what it's like to run and operate a trades business, but I've had some experience on job sites, at least a very minor amount, but I sort of understood. I think it's helped me a lot in what I'm doing now, in understanding sort of how the money actually moves down a job site. So it sort of waterfalls, if you will, from whoever's running the job through to different subcontractors and so on. So despite the fact that the Securities of Payment Act actually guarantees a lot of your payments, even if they're sort of more so handshake agreements, they're still very difficult, even if you've got an actual contract with a job that outlines a schedule of income for the coming 12 months. There are lenders out there that will discount you guys specifically because of your industry and just say, well, we don't believe that this contract is as, let's say, as solid as someone who might be selling oranges to Woolworths on a recurring monthly contract, which says we will buy X units of oranges off you at Y interval for Z price. So you might have, as Glenn said, you've got a lot of jobs lined up, all under progress payment arrangements. And so it's good to see that you've got a nice little good ledger of work lined up. But there are times when some lenders will actually just straight away discount trades businesses from their own funding criteria, specifically because they consider it a riskier industry. Whether they're right or not, I think is probably, I think they are probably wrong to discount this as an industry, because I think there's not a lot of players who have decided that their niche will be lending to trades business owners. But considering the movement of the market, more and more these lenders out there that are private lenders as opposed to banks are finding that in order to compete in an industry that has a lot of players, they're going to have to find some way to differentiate themselves from all the other players who are doing very similar things. So I think that will spell over time good news for the trades industry. I think people will come out and decide specifically, I'm going to try and assess and basically address the issue of invoice financing or working capital funding for trades owners. You can jump to the next one, please, Glenn. So how are they different? A lot of them differ very specifically in that they're not doing a bank style assessment of something which involves a human sitting there and actually manually going through bank statements, manually looking at documents and so on. Technology allows them to understand the parameters of which a business operates, not only much quicker, but to a much higher degree of accuracy, and using algorithms and so on, they can draw not only on the obvious data that's there, but they'll get an understanding of, and the way it works basically is a lot of them will send you a link. So if you've applied for a loan with them, they'll send a link to yourselves. They'll ask you to fill in and give permission for you, for them to read your bank statements for the last 3 months for the business, or for 3 months or 6 months or 12, depending on how much you want and what for. They'll do a very quick assessment of that. It will essentially spit out a number that says we assign this level of risk to the business, and then that will ultimately result in the pricing for any capital that you actually get from a lender. So as opposed to the older style assessment where you'd have to gather 2 years of accountants' financials prepared by an accountant, so you'd have to wait till the end of July, wait for them, get that over to the banker, or make an interim financial report. That will get sent off to the bank, which is then assessed over the course of a few months, and they determine a result. In this case, this can be done in as little as half an hour. They'll send you a link. It will literally scan your records and your accounts to see how much money went into your account, how much money went out of your account, and what the average cash balance is at any one time. So for them, their assessment is not necessarily about what the same way that a bank's is. A bank looks at it and says, this is a risk. Smaller private lenders look at a deal and think, this is an investment. So a very fundamental shift in mindset from, it's risky for me to lend money, therefore I must know everything about your business, take security in the form of an asset that you own, and then assign a certain product to you. It's more of a case of, let us understand how the money flows in and out of your business. So let us understand your cash flow situation, and then we'll give you an amount that we feel will help bridge that problem, or we'll offer a product to you that we think will help you manage your cash flow. So a good example would be, there are lenders who will essentially read it as well. I'm sure that Glenn's spoken to some of you guys about accounting technologies like Xero or MyOb and so on. There are a lot of lenders that will use that as a way of part of their assessment. So again, as opposed to you having to go to the accountant, get everything prepared by them and then physically submit that somewhere. If you've got everything on, or if your accountant's got everything on Xero or MyOb, you can request documents from them very quickly, so they can put together a profit and loss and an asset and liability very quickly. They'll just pull it out as of a certain date. They'll just pull it out. But as long as everything's reconciled, then happy days, the whole thing works out, and we'll give you an actual up-to-date profit and loss of everything that's gone on in the business, and then that can be sent directly to a lender to assess that afternoon. So just another reason that I think a lot of what Glenn said has actually been fantastic in offering systems and things that will help. Sorry, 2 seconds. Sorry, just had someone walk into the room and ask them to leave. So yeah, as opposed to that traditional way of looking at things, these guys will basically get a very quick idea of what is it that your business does. So how quickly does the money come in or out? And how much money do you have at the bank at any one time? And because they're not taking a security over a house, they're going to really drill into essentially, does your business have enough work coming in to support a loan of this size if we take into account your income and your expenses and how much money is at the bank at any one time? If you could jump to the next one, please, Glenn. So because of the, ultimately, because a lot of these guys will decide the best way that we can approach the market is to create a point of difference, and then we'll go to that market. What you find is that this industry also has a lot more players in it, because unlike a mortgage industry or the personal loan industry or the car loan industry, which is very regulated by not only, is basically very regulated by APRA. So there's a lot of rules around lending money to an individual, a lot less so in the world of business finance. So your application goes from, let's say you were to apply to a bank for funding, it's treated very differently if you're applying as your own personal self versus you applying as a sole trader and that business applying for the loan. The big difference is basically if you're applying under your own personal name, then you need to use income through a job or through your own salary from your business to pay that loan, as opposed to the assessment whereby if the business is the one applying, then the business itself has to stand up to the ability to pay back that loan over the term and meet the repayments as outlined according to the schedule of payments. So there's a very fundamental way as well that it differs in personal lending, so mortgages, car loans and personal loans. There's a very specific way that any lender has to actively spell out for you what it is that you're signing up to. And typically that will take the form of an APR, so an interest rate. So for a mortgage, you know, you're sort of looking anywhere between 3 and 4%. That's sort of like your average pricing range. But because we're not talking about longer 35-year mortgages, we're normally talking about smaller capital amounts, 30, 10, 50, 100 grand for a specific business purpose, which will result in you then gaining a new contract or something, which will actually help you pay off that loan itself. So as opposed to looking at a historic view of the business and saying, is it possible for this business to manage this debt that they're taking on through their historic trading? A lot of these lenders look at, what are you going to do with the funds? How will that have an impact on your own turnover, cash flow, and profitability? And will that then enable you to do something which will increase your own ability to pay back the loan? And then that's how you will pay the loan. So a different mindset. There's another different mindset in that they're not like banks. They're looking at a very heavy focus on relationship. So a lot of these lenders are not as big as banks. They don't have the staff, the salespeople and so on to compete with some of the larger lenders or banks. So for them, when they find a customer that is a good customer for them, likes the terms, is happy to work with them, they work really, really closely with them. And there are some lenders that have fantastic ability to sort of empathize with whatever's going on in your business. So for instance, there are some lenders I've met who, they work really closely with the people we've helped them to borrow the money. So in some cases, they might have fallen across some random hardship that they didn't encounter or they didn't expect. So for instance, I had a client who only borrowed a relatively small sum of $20,000, intention to pay it back in a 3-month term. Very, very unfortunately, she had a death of a close family relative. Because it was not her first facility with that lender and they recognized the lifetime value of her as a customer, they pretty much said, look, we understand that something has really, really gone. We're going to basically say we don't need any repayments for the next 3 weeks. We'll essentially put this whole thing on ice. You go away and sort of do what you need to do. And then we'll crack on with repayments in 3 weeks' time. So they gave them a bit of a grace period to sort of get away from work, deal with the emotional trauma they were going through, and then, back on the tools and back to paying that loan. There's another element to that as well. It's just something to be mindful of is because there's so many lenders in the market, a lot of them, they'll make claims about things like they do in quotation marks, like a soft touch approach to assessing your credit file. They couldn't be, it's a practice I think they should probably outlaw. The truth is, if someone looks at your bank statement, if not your bank statement, but if someone looks at looks into your credit file, it will, without any, unless it's yourself looking at your own credit file, there will, without a doubt, be some mark left on your credit file that other lenders will see, and that might potentially result in you being denied of a loan. So as an example, there's a very common lender that a lot of people go to as the first point of call. They themselves do a working capital product as opposed to an equipment loan. What I find is that they do a lot of assessment of people who have applied for an asset, despite knowing that they're probably very unlikely to approve the loan. They'll still do their assessment. That assessment will basically make a mark, if you will, on that client's credit file. And then they might go from that lender to the second lender, being probably where they should have gone in the first place, an asset lender who will go through their records, see and realize you've had an application pending very recently. They'll dig into that. Who was that with? What happened there? Why were you denied? Did you put in an application? How come you weren't approved? And so on. And it just essentially creates a bit of friction between the lender and the borrower, and the lenders in most cases will decide to pull out because they can't quite, ultimately they go, well, if you failed that other company's risk assessment, then it's very likely you'll fail our risk assessment. So we don't want to proceed. If you could jump to the next one, please, Glenn. Another thing to note is considering the amount of players in the market, there's quite a varied lending policy and interest rate. So as I was saying before, the way that a lot of these people price things is different. So where in mortgage world, ultimately you've got to tell a customer, this is what you're paying as an interest term. If we were to calculate that as a yearly interest rate, so it will always indicate your yearly interest rate. A lot of the time they'll use things like, in small business lending, they'll use things like a factor rate, which essentially means that rather than them having to say, you're paying back a loan at 20% interest, or you're probably seeing there's a pretty unbelievable range on unsecured loans, up to 80%. I've even seen as high as 120, 150%. But again, that's all based on the fact that their pricing is done according to a factor rate. So for instance, if I borrowed $10,000 today, if I was doing that through a bank on a personal loan, they'd say, this is your interest rate, maybe 10%. The term is 5 years. You'll make this repayment on a monthly schedule and you'll be debt-free in 5 years' time. They'll also give me some conditions. You can early pay out in a year, you can pay out early in 6 months, you can pay out early this time, and so on. So they'll give me very, very defined terms. As opposed to that, in business lending, you might apply and say, I want to borrow $10,000. The lender will send you that bank statement link. That link will analyze your zero and your trading history through your bank statements and assign a risk to you. So that risk factor might be 1.2%, say, or 1.25. And then ultimately they apply that rate to the funds, and then that's what you pay back. So for instance, if you apply for a $10,000 loan and you're given a factor rate of 1.2, you'll pay back $12,000 for that loan. And that's the way it will be expressed to you as a customer. So as opposed to expressing it as a 20% interest rate, whereby you're borrowing 10, paying back 12 over a year-long term, so a 20% interest rate. In this case, they'll say to you, we're going to give you 10 and you're going to pay back 12. So essentially they're avoiding quoting it as an interest rate because it looks comparably high compared to the things that people are used to in mortgage land and in personal lending land. So I think probably what I should have said then is in SME lending and commercial lending, the sort of interest rates and things that you'll see on them are inherently going to be a lot higher because there's a lot more risk involved in lending to a business than there is lending to someone's residential home, especially if it's a two-income family with two parents working, and no children, and they've got a big income and they're relatively comfortable in servicing that mortgage. If you could jump to the next one, please, Glenn. So again, the way that a lot of these guys have sort of niched out is by trying to find different industries. It's true that there is quite a lot of choice in the market, but in all honesty, a lot of them offer very similar things. The four things I think most lenders will look at is a healthy cash balance in the bank. So ideally, you're not going into deficit too often. And I think a lot of this ties into what Glenn was saying. If you can make sure that your pricing is right, you're winning those sort of clients that you want to work with. And I think there's a lot to be said for sitting down and working out what you make the most margin on, and then very specifically targeting that kind of work from then on. And I think it's also important, like Glenn said, that you make sure your pricing works out so that you're not just charging what the bloke down the road is, and then your expenses actually, is more than that. So the other thing we're looking for is a consistency in turnover. So you can imagine if I was going to lend you $10,000, I'd want to see that you were earning a regular income. So if I'd lent you $10,000 and I said, you're going to pay me back on a schedule of $1,000 a month for 10 months, or we'll do 11. That way you're paying me back 11 and I've made $1,000 as an investment. I might say to you, well, what do you earn per month? And if you say, look, I actually work according to quite an odd schedule. I don't get paid monthly, I get paid every 6 months. I might in that case say, well, look, I'm a bit hesitant to lend to you because I'm giving you 10 grand and I'm not going to be getting anything back until 4 months time from now. So a consistency in average monthly turnover would be good. So again, goes to Glenn's point, if you can systemize the business so that you're working on good quality jobs with a good margin, and then you can get yourself off the tools and have other people doing that work for you, then you're going to have a much more consistent turnover as opposed to it being quite lumpy every 3 months, 2 months, or 5 months, so on, depending on sort of the jobs that you work on. The other thing they want to see is a profit at the bottom of your balance sheet. So like Glenn said, hopefully we can get you in a position where you're actually going to your bookkeeper or your accountant and you're absolutely skipping there, waiting to see what your actual net profit was for the end of the year, as opposed to hoping it doesn't come out in brackets and you're looking at a loss for the year. So a profitable business is a business that can be lent to. A business that's making a loss is a business that's hard to fund because there's not enough money in the bank to make the repayments as they fall due. The last thing they'll look for is some form of asset to take charge over. So whether that be your home, or whether that be a truck, a van, something like an excavator or a digger, but something that they can take, and ideally they're looking for an asset that they can sell. So the key there is whatever they're lending to has to be something that they can resell with relative ease. So for them, it's easier to sell a truck than it is an excavator. And it's easier for them to sell an excavator than it is a concrete pump. So you can understand, depending on how resellable that asset is how much that lender will want to lend according to the value of that asset. I've just got 2 or 3 more very quick ones, but I'll jump more so to examples on specific financing forms that I've seen before that have been helpful to trades owners. But if you jump to that next one, how do they differ from banks? Essentially, they don't require security, don't require up-to-date financials, so they'll look at low doc solutions, again, using those sort of bank statement leak assessments as opposed to assessment of financials. They'll accept a business that hasn't been operating for 24 months with financial history. And some of them will accept an invoice as security for a transaction as opposed to needing to take a security in the form of a residential house or a commercial property or something like that. Just on that next one, so the most common cases of finance that I personally have seen for trades business owners include, and I've sort of tried to make it in line there with the journey of most trades business owners, but initially there's a startup cost involved. Now you might be working in a franchise, so there might be a franchise cost. There'll be, purchase of tools, purchase of vans, equipments, maybe leasing or rental and so on. I've tried to group that into equipment as well. So startup phase, ultimately, I think the best advice I can give to anyone there is if you are starting out, or if you are, you're friends with a friend who is starting out, or who maybe is coming up to the end of their apprenticeship and is thinking of going out on their own, the advice I would give to anyone is save more than you think you need before you go out on your own. There's nothing, as the old saying goes, there's nothing wrong with staying and work as long as you've got money coming in, but it's not a lot of fun sitting around with no work to do and no ability to do the work. So I'd always tell everyone, work out how much it is that you think you need to start and then double it, and then you're probably factoring, just about the right amount. From a working capital point of view, again, what lenders are looking for is consistency in turnover, but most people will borrow money on a short-term basis because they have a staff bill coming up. They might have a whole lot of money tied up in incoming, so invoices of debtors that are very slow to pay them. Or it might be that there's an upcoming job and there's a big invoice in it for yourself, so a big payday in it for you if you can win the work. But as opposed to having everything you need today, it's one of those jobs where you've got to go out and buy a whole lot of equipment and tools that are quite specialised, and then that will allow you to do the work, which will then result in you receiving that invoice. So there are financiers who understand that mentality. So rather than them taking again or lending against your turnover or so on, they'll take a look at the invoices that you're owed. They'll do a bit of an assessment on the companies that they think, that you're working with, and see that they consider them to be good, solid invoices. And then they'll actually give you a set line of credit, or they might allow you to draw down a certain amount based on the amount of owed debts that you have. Outside of that, probably the more common one is equipment. I think I've semi-covered what I could think, but normally it's vehicles, so vans, utes, trucks, and so on. A lot of things to consider here, especially, and like I said before, if you've got quite a specialised asset, so if you work in concreting, excavation, fencing, or fencing hire, or so on, there's a lot of different asset classes, and they run from category A, which would be something like a truck, van, or car, something with a very good resale market, through to categories B, which again is things like your diggers, yellow goods, and so on, through to category C, which is things that ultimately maybe don't have a serial number, or something that it's very hard to track. So there are very specialist niche lenders out there. There are a dime a dozen, the good ones, but there are people who can help you with some of the weirder assets. Once you've grown to maybe a certain size, or some of you might be at a point now where you're actually considering purchasing those vehicles. So when you're starting out, it's definitely worth a conversation to your accountant around, should I be renting or should I be purchasing these vehicles from the get-go? There's various tax benefits to both.
Jack, we might have to slow you down there, mate. We're just getting outside of our webinar length. So yes. Just a couple of points that I've picked up on, I guess I'd like to bring everyone's attention to. You're saying that cash flow is king when lenders are making a decision about a trade business, and that's largely because they're making an assessment of the bank statements. Am I understanding that correctly?
That's exactly right. So you can imagine in an industry like you guys work in, or a cafe owner or someone works in, where there's quite a lot of turnover, but there's also quite a lot of expenses. If they were to do an assessment of your financial statements, it might show an incredible revenue, but they would have to ignore the expenses element of that in order to count that as revenue.
Yeah. Yeah, it's fascinating. And you also pointed out that the private lenders are going to be a lot more open to trades business needs, and they're going to the wrong lender first is just a disaster in terms of trying to put something together. So, look, I think that's fascinating. I've learned a lot. Really appreciate you being involved. Any final comments there for us, Dirk?
That'd be about it. I think if anyone wants to know more, sorry I went over it. I sort of felt I was a bit there. I should have sat here and timed it. I was trying to think about how far I'd been in.
No trouble. No, good. Look, really fascinating subject, and one that a lot of trade business owners struggle with. So really appreciate your contribution. But look, just to wrap things up, guys, I suppose the question that Jack and I both ask is where are you going to be 5 years from now? Because for a lot of you, if you keep doing exactly what you've always done, your financial position in 5 years is probably not going to be a lot different. But if you adopt some of the things that I've tried to share today, and Deck's pointing out, then your financial